So hello friends, right now we are going to start with our day 9 and we are moving to another sum. So right now I will be doing with you all the sum number 16. So we are going to start with sum number 16 right now. You are required to determine the weighted average cost of capital using book value weights and market value weights. So again I will be solving the market value weights. The book value weights are these weights. So this we have already done. So the following information is available for your perusal. The present book value capital structure is given. They have given us debentures, preference shares and equity shares, and all those securities are traded in capital market. So if the securities are traded in capital market, it means the market price is available. Recent prices are debentures at rupees 110, preference shares 120 and equity shares 22. So this is the market price of all the securities. Anticipated external financing opportunities are rupees 100 per debenture is redeemable at par, 20 years is the maturity, 8% is the coupon rate, and coupon rate is nothing but the interest rate. 4% is the flotation cost and the sale price is 100. And then rupees 100 preference shares redeemable at par, 15 years is the maturity, 10% is the dividend rate, 5% is the flotation cost and the sale price is 100. Then equity shares of rupees 2 per share, flotation cost and the sale price is 22. In addition, the dividend expected on equity share at the end of the year 2. In addition, the dividend expected on the equity share at the end of the year is rupees 2. So this is the future dividend, that is D1. The anticipated growth in dividend is 5%. So the growth rate they have given it is 5%. The company has the practice of paying all its earnings in the form of dividend and the corporate tax is 50%. So let's start with the sum. So what I will be doing I will be going by the order. The first one is that I have to find the cost of debentures which are redeemable. So we are going to find the cost of debentures and these are redeemable. So I will be drawing a timeline. Rupees 100 per debenture, they are redeemable at par. So the redemption value is rupees 100. Par means they are redeemable at this face value which is 100. So their redemption value is 100. 20 years is the maturity, so N I will take it as 20 years. 8% is the coupon rate. So coupon rate is the interest rate. So interest is calculated on face value into the coupon rate. So the face value of the debenture is 100 and the coupon rate is 8%. So the interest 8%. So the interest will be 8 rupees. So we will have an interest of rupees 8. So we are going to have an interest of rupees 8. Then 4% is the flotation cost. I have told you all that the flotation cost the CA Institute is taking on the face value. So I will also be taking it on the face value. So the flotation cost we are going to take on face value. So face value into how much is the flotation cost is 4%. And we have the face value which is 100. So 100 into 4% is going to give me 4 rupees as my flotation cost. and the sale price is rupees 100. It means I have sold the debentures in the market and I have collected rupees 100. So the sale value is rupees 100, and out of this 100 I have to spend 4 rupees as my flotation cost. So in hand the net proceeds, that is the net amount which I am going to get into my hand, is 96 rupees. And the corporate tax rate is 50%, so we will take tax at 50%. So I will be solving the cost of debentures, that is interest, then give the effect of tax savings. So 1 minus tax plus the redemption value minus the sale value upon the number of years. Then we have redemption value plus the sale value divided by 2, and this entire we need to multiply by 100. So what I am going to do is I am going to rub this part. You all can pause the video and then again go through that part. So I will be solving here. So this way I am solving here. So the interest part is 8. 1 minus the tax is 50%, that is 0.5, plus the redemption value is 100, then the sale value is 96, divide by the number of years are 20, upon the redemption value, which we will take it as 100, then the sale value will be taken as 96. This we are going to divide by 2, and enter this we are going to multiply by 100. So 8 and 0.5, so this will be 4. Then so I will be doing it. So I had paused the video since there was no calculator with me. So 100 minus 96, that is 4, I will divide by 20, so I will be getting 0.2. So this I will be taking at 0.2. Then this I will be solving, that is 196 divided by 2, so I am going to get 98, and this entire we are going to multiply by 100. So 4.2 divide by 98, divide by 98 into 100 will give me how much? 4.2 divided by 98. So I'm going to get 4.29, approximately this much percentage I am going to get my cost of debentures, that is 4.29. Now we are moving further to find the cost of redeemable preference shares. So now we are going to find the cost of, so we are going to find the cost of redeemable preference shares, and I'll write the formula. Cost of redeemable preference shares is your preference dividend per annum plus the redemption value minus the sale value upon the number of years, and then redemption value plus the sale value divided by 2, and this entire we are going to multiply by 100. So here I will be writing all the details of whatever they have given to us. So rupees 100 preference shares redeemable at par. So at par means the face value is 100 and these preference shares are redeemable at 100. So the redemption value is 100. They are redeemable at the par face value. Okay, and 15 years is the maturity. So the N we will take it as 15 years. Okay, then 10% is the dividend rate, and I've explained to you all that the dividend will be calculated on the face value of 100. So 10% is the dividend rate. So we are going to calculate preference dividend, which is the face value into the rate of dividend, which is 10%. And you can see that the face value of the preference share is 100. So the face value is 100 into 10%. So I'm going to get a preference dividend of 10 rupees per annum. So this I have found out. Then 5% is the flotation cost. So the flotation cost we are going to calculate on the face value. So the flotation cost we are going to calculate on the face value into the rate of the flotation cost, which is 5%. So 5%, and you are aware that the face value is 100. So 100 into 5% is going to give me 5 rupees. So 5 rupees is my flotation cost. And the sale price is 100. It means that I have sold one preference share at rupees 100. So the sale value is rupees 100. And out of that, I have to spend 5 rupees on this flotation cost. So in hand, the net proceeds which I'm having is 95. Okay. So I think the entire data is there with us. So now we can move to find the cost of preference shares. So the preference dividend is 10 plus the redemption value is 100 minus the sale value is 95 upon we have 15 years. Then the redemption value is 100 plus the sale value is 95. Then this we are going to divide by 2, and this we will multiply by 100. So you have to be alert that I will be solving this part. So I will be solving this part over here. So this will be solved here. So 100 minus 95 is going to give me 5 divided by 15 plus 10. So I'm going to get 10.33 upon, and 195 I'll divide by 2, so it will be 97.5, and this entire into 100. So 10.33 divided by 97.5, so percentage. So I'm going to get 10.59%, and this would be the cost of the preference shares. So now we are moving further. Now we have to find the cost of the equity capital, that is the equity shares, and you can see there is growth rate. So we are going to find it. So now what I'm going to find is the cost of equity, and by the dividend growth model we are going to find. So the cost of equity, that is your future dividend, then the current market price minus the issue expenses, and you have to add to it the growth rate, and this entire we are going to multiply by the 100. So here I will be writing all the details. So let's move. The equity share rupees 2 per share is the flotation cost. Okay. So I know the issue expenses, that is the flotation cost is rupees 2. So I will be writing all the data over here. Then in addition, the dividend expected on equity share at the end of the year is 2. So the dividend expected at the end of the year, so I will say that this is the future dividend, which I can take it as D1, and the D1, the future dividend, is again rupees 2. Okay, so I missed out something. The sale price is 22. So the sale price means the market price. If I sell the equity share today, so I will be receiving a sale price of rupees 22. That means the current market price is 22. Then the anticipated growth rate in the dividend is 5%. Okay, So they have given us the growth rate, which is 5%, or you can take it as 0.05. So I am solving it. All the details we are having with us. The D1 is 2, so here I will be writing 2. The pre-0 is 22, minus the issue expenses are 2, plus the growth rate. The growth rate is 0.05, and this entire we are going to multiply by 100. So 2 I will be dividing by 20. So 2 dividing by 20 plus 0.05 into 100. So I'm going to get the cost of equity equal to 15%. Now I think we have found out everything. So cost of debentures, cost of preference shares, cost of equity, everything we have found out. Now we are going further, and now we need to find the market value. So what we are going to find, the market value of the securities. So I have debentures, then I think I have preference shares, and then I'm having equity shares. So we are going to calculate the numbers of debentures and all those things. So 8 lakh I am going to divide by 100. So if I divide 8 lakh by 100, so I am going to get 8,000 debentures. So here there will be 8,000 debentures. Then what is the market price, we will see. Then the recent market price of the debenture is 110. So we know that the market price of one debenture is 110. So 8,000 into 110 will give me 8,80,000 is the total market value. Similarly, we have to do it for preference shares. So 2 lakh I am going to divide by 100. So 2 lakh if I divide by 100, so I am going to have 2,000 preference shares. So 2,000 will be the preference shares, and the preference shares at 120. So the preference shares are having a market value of 120. So into 120 if I do, so I'm going to get 2,40,000. So this will be the value of my preference shares. Then we are moving towards equity shares. 10 lakh if I divide by 1, so I'm going divide by 10. So I'm going to get 1 lakh equity shares, and the value is 22. So 1 lakh equity shares and the current value is 22. So 22 lakhs is the market value of all the securities. So now what we are going to do is we are going to move further, and we are going to calculate the weighted average cost of capital, which is KO, by using market value as our weights. So market value as our weights. Okay, so here we will write the sources. Here we will write the market value, or you may say amount. Then we are going to get the weight of that market value. Then we have to get the cost of capital in percentage, and then the weight we are going to multiply by the cost of capital percentage. This we will name it as WACC. So now I know that there are three sources. One is the debentures, the other one is I think the preference shares, and the third one is nothing but the equity shares. Market value we have found out 8,80,000, 2,40,000. So 8,80,000, then we have 2,40,000 and 22 lakhs. So next is 22 lakhs. So what I will be doing, I will be adding the 3. So 8 lakh 80 plus 2 lakh 40 plus 22 lakhs. So you're going to get 33 lakh 20,000. Now this 8 lakh 80 I'm going to divide by this 33 lakh 20,000. So 8 lakh 80 you are going to divide by 33 lakh 20,000. So you will get 0.265 as your weight. So 2 lakh 40 I will be dividing by 33 lakh 20,000. So 0.072 will be taken as my weight. This is 1, and this we are going to take it as a balancing figure since I have rounded off the two answers. So 1 minus 0.265 minus 0.072. So I will be getting 0.663. So 22 lakhs, if I divide by 33 lakh 20, 0.663. The same answer we are going to get. So debentures, we are going to see the cost of capital, and how much is the cost of capital for debentures. So the cost of capital for debentures is 4.29. So 4.29. Then we will get the cost of preference shares. So cost of preference shares is 10.59. So 10.59 will be the cost of preference shares. Then we are going to get the cost of equity, which is 15. So cost of equity will be 15. So this and this I will be multiplying, that is weight into cost of capital. 0.265 into 4.29. So I'm going to get 1.13685. This I'm going to multiply by 0.072 into 10.59. So we are going to get 0.76248. Then 0.663 into 15. So 9.9945. Then we are going to get the overall cost of capital. So 1.13685 plus 0.76248 plus 9.945. So I'm going to get 11.84 approximately. So I'm getting the overall cost of capital is 11.84 percentage. So now we have completed this sum. I hope you all are understanding. See you in our next lecture. Thank you.